So what's the challenge that we face as we move towards retirement? Well, there's three factors that are driving the challenge. The first one is longevity. As a society, we're living much, much longer. And what that means is when we retire, often retirement, the next phase of our life can last 20 or 30 years. We have to have the financial resources to support that. The second major factor we face, and we've experienced a bunch of this in the last year or two, is inflation. The cost of living keeps going up. So we have to plan ahead when we plan our retirement to have sufficient income to make ends meet, to cover our lifestyle. And the third factor is one that a lot of times people don't think about, but when do we define the lifestyle we want to maintain the rest of our life? We usually do it while we're working. And we do it because we have income coming in on a monthly basis. We feel confident paying our bills. And so we establish a lifestyle that we want to sustain. But what often happens when we retire, sometimes the source of income coming from a job goes away. And so today we're going to talk about ways to pay for retirement. And the first two are the principal assets that you and I have as we move into retirement. Most of us have a home that has built up substantial equity. And so that's a source of funding that can help support retirement. Many of us also have 401k or IRA accounts. These are pre-tax accounts that we've contributed to while we're working. And then finally, many of us have sources of income in retirement. So we're going to talk about each one of these three and see which ones we'll need to tap to support and sustain a quality lifestyle. So for many people, their home is their principal asset. And so as we move to retirement, many of the clients we talk to are house rich, but maybe potentially otherwise asset or savings wise, relatively poor. Most of the equity they have is tied up in their home. So here are three strategies for managing and essentially multiplying the effect of the home equity that you've built up. The first one is downsizing. And there we sell a large McMansion and move into either a smaller home or an apartment or a condo. And in the process, we free up capital. And the good news is today, when you sell a home, if you're single, you can shield up to $250,000 of gain from long-term capital gains tax. If you're married, the number's double, it's 500,000. So this is an interesting way we downsize, we free up capital that can then be used to support lifestyle, and it's tax-free income. The second one is one that we hear about a lot. Many of our clients have a son, daughter, family member who's moving back home. And, you know, it was wonderful when the kids were growing up, you paid for their food and their rent and you covered it. But now it's time, as they move back home after being out of the home, it's time to a part of living in the home. And that's renting out a room or a wing of a room. In our home out here in Burnet, Texas, we have a carriage house, and we're in the process of renting it out as a source of income. The third major opportunity with homes is tapping home equity. And what we're talking about there is the ability to actually take equity out of the home. And there's two ways to do it. You could get a traditional home equity loan. The downside to that is that you have to start making payments back. An alternative to that, one that's becoming more popular now, and it has a tarnished reputation, but it's actually becoming a lot more attractive, is doing a reverse mortgage. This is something that's eligible for people 62 and older, where they can tap home equity, tax-free, take money out. You can do it both on a lump sum basis, or you can set it up as a lifetime income stream. The advantage to a home equity loan, a reverse mortgage home equity loan, is that you don't make payments back while you're living in the home. If you move out within a year after that, you have to settle up with the reverse mortgage company. And one of the misnomers about a reverse mortgage is people say, well, I no longer own my home. And that's not true. See, the most they will loan on a reverse mortgage is a portion of the equity that you built up. So there's always equity still in the home. For most people, after they move out, they sell the home, there's a settlement, you settle up on the mortgage, and the remaining equity either goes to you or to your heirs after you've gone to heaven. So these are options that we talk with our clients about. If you're home rich but otherwise asset poor, come and talk to us. We don't do reverse mortgages, but we have a number of affiliates. One of them is somebody we've worked with for a number of years that does reverse mortgages, and they can explain the process, how much you can get, and what the costs are associated with doing it. Now, the second major asset that most of us have in retirement is a retirement account that we built up while we were working. Might be a 401k, might be an IRA. These are generally pre-tax dollars that you've accumulated, oftentimes with an employer contribution. And then when you leave employment, you take the 401k or the IRA with you. Now, what are the factors that impact 401k and IRA funds? The first one is market volatility. And over the last 3-4 years, mostly the markets have been very positive, very up. And that's great. The challenge is right now we are underwater from the first of the year coming forward because of some of the political events in the world and at home in the United States. And so we've seen the markets decline. And one of the challenges with an IRA or a 401k is we don't want to tap funds when the market is down. If you do that, that can diminish or reduce or eliminate the potential of being able to draw funds to support lifestyle. The second factor and third factors that come into play with IRA 401k funds, if you have an IRA or a 401k, today when you turn 73, the government mandates that you have to start taking required minimum distributions. This is a calculation that you do every year as you get older. You get the value on January 1 of that year, and you go to a table, and the table lists ages from 73 up to 115. Next to each age in the table is a divisor, let's say 26.5. I'll use that as an example. So how do you calculate the RMD for a given year? You take the value of all of your IRA 401k investments on January 1 and divide it by that divisor. And for people turning 73, the amount you have to take out is about 3.5%. Every year as we get older, the divisor gets smaller, which means we have to take a larger percentage out of our IRA or 401k each year. The third factor, taxes. Usually all the funds inside of a 401k or IRA are taxable, which means we have to pay tax. We have to give a portion of whatever we get to Uncle Sam. But one of the strategies we use in our practice, people that have substantial 401k or IRAs, we show them how to take a portion of their IRA or 401k and generate an income stream off of it. The income stream that is generated satisfies the RMD requirement on an annual basis. So you're keeping Uncle Sam happy. You're taking your RMDs. As you start drawing this lifetime income, by the way, if you're married, we set it up as joint life. So it pays out whether he or she or whoever's alive, it's paying out. When those payments start coming out, as with RMDs, they're taxable. But we have a way of converting that taxable income stream into a tax-free income stream. Usually it takes 10 or 11 years. So let's say you retire at age 70 and start taking income out, which you can do at whatever age you want. The income is taxable. But after 10 or 11 years, there's a way of converting your traditional IRA to a Roth and then go forward. After 11 years, future payments are tax-free. If you're interested, if you have a large IRA or 401k and you're interested in this strategy of creating some lifetime income that eventually becomes tax-free, give us a call. We're happy to answer questions and show you how to do it. The third major method for paying for retirement is from income. Most of us will qualify for Social Security benefits, and if you know anything about Social Security, you can claim as early as 62. You can claim up to or at your full retirement age, and then if you want, you can delay Social Security benefits and delay them up till age 70. What's the advantage to delaying? Well, you start out with a higher number. If you claim it, if your full retirement age is 70 or is 67, and you claim at 62, you start out with a benefit that's 70% of what your full retirement age benefit would be. If you claim at full retirement age, you get your full benefit. If you delay beyond full retirement age to age 70, you can get up to an additional 24%. It's an 8% roll up past full retirement age. We show clients how to maximize their lifetime payout. And if you have an interest in this, contact our office, go to our website. You can request a copy of our book, More Money for Retirement. There's a very interesting chart in that book. It shows if you start claiming at 62 or at 67 or at 70, what's the cumulative lifetime payout? Guess what? All three lines cross at age 78. So I usually ask people, do you think you'll live beyond 78? Most of them shake their heads, yes, I think so. Well, if that's the case, waiting or delaying Social Security means you'll get more money out over your lifetime by delaying benefits. So we help people make smart Social Security claiming choices. But with Social Security, it's even more complex than what I've touched on. You've got the challenge of do a claim on your own work history. If you're married or have been married, you have the potential of being able to claim on a current or ex-spouse. And if you're widowed, you have the ability to claim a survivorship benefit against deceased ex-spouses. Sometimes that means multiple claiming options. So if you have questions on Social Security, call us. We can show you how to maximize your lifetime payout. And if you're the primary breadwinner in a married situation, something to think about is not only are you increasing what your benefit will be, but if your spouse outlives you, that spouse steps up to a higher lifetime Social Security benefit. Because when you're married, the surviving spouse gets the higher of the two benefits. The second option is continuing to work. And some of our clients are in challenging, high-stress jobs. They're looking forward to retirement. But oftentimes we talk to them about the possibilities of working part-time, finding something that's less stressful, more enjoyable, but that generates recurring income. And as we'll talk about a little later, we build retirement plans. And the impact of additional income over your working time can dramatically improve your financial outcome so that you don't outlive your savings. A third option for generating a lifetime income are CDs and bonds. And these are very well established. CDs are offered generally by banks. Bonds are offered by financial institutions, by companies, and they generate a fixed rate of interest. And so if you have enough funds, you can fund CDs and bonds to generate a lifetime stream of income. The challenge with CDs and bonds is that interest rates fluctuate. So the last couple of years, we've seen the Federal Reserve raise interest rates, which has driven up the interest returns from CDs and from bonds. But now we're in a process where it appears interest rates may decline. So for folks that are living on CD interest rate, when they go to renew their CDs, sometimes they get a lower payout. It's not something that's guaranteed over their lifetime. A fourth option are stock dividends. My deceased father-in-law, not deceased father-in-law, was big on stock dividends. He liked investing in stocks that pay high rates of annual dividends. And some of those dividends can be tax efficient. They're qualified bonds or stocks that pay out tax attractive dividends. Once again, Stock dividends aren't guaranteed. It's based on the company or organization's ability to pay the dividends, and sometimes that fluctuates over time. Companies that are doing well don't do so well, and they have to cut back on their dividends. Another option that's very popular with some of our clients are rental properties. If you are involved in real estate rental, you know that there's some substantial tax advantages to renting out properties. You can write off depreciation, which can make the income you're receiving much more tax favorable, where you're not paying the full tax on it. And so rental properties can be an opportunity to investigate. The last option we have on here are annuities. In our retirement planning practice, we're very big on generating guaranteed income for people in retirement. I mentioned using an IRA or 401k to generate lifetime income. Well, you can do it with both pre-tax money, like an IRA, but you can also use after-tax savings and set up an annuity that generates a lifetime stream of payments. If you fund it with an IRA, as I mentioned earlier, eventually the payments become tax-free. If you use after-tax funds, the payments that they're making to you while there's money in the annuity, those are tax efficient because you're essentially being paid back your premium, what you paid in. After you've drained the annuity after 10, 11 years, then the income stream becomes taxable. But we show people how to generate lifetime income. Why is lifetime income important? Well, like Social Security and annuities, you're setting up something that is going to last the rest of your life. Work is based on our ability to work, our physical ability to go to a job, to perform a task. Sometimes our health fails, so we can't sustain work long term. CD interest rates, stock dividends, those are based on factors that are outside of our control. They're based on the interest rates set by the Fed, and they're based on interest rates or on dividend rates set by companies, which once again can fluctuate. And finally, with rental properties, properties can go unrentable. When I moved to Texas in 1985, Texas was at the end of a boom period. But after that, for the next 4 or 5 years, a lot of rental properties went vacant as people left the city. So we favor programs or approaches, strategies where you can create guaranteed lifetime income. And we believe Social Security and annuities provide factors that allow you to do that. So those are 3 different ways that you can pay for retirement. But paying for retirement is only one part of the process. There are other, what I call potholes. The first one is understanding where you're going to be financially down the road. In our practice, we have some very powerful software. It's known as Retirement Analyzer. And it kind of gives us the ability to tell people, based on your income, your savings and earnings, based on your lifestyle expenses, here's where you're going to be 10, 15, 20, even 30 years into the future. Our software computes the effect of taxes, inflation on a set of numbers, and it helps pinpoint that you're strong at age 85, you're strong at 95, but at 98, you've run out of money. You're living on whatever guaranteed income you have at that point. Our models give us the ability to look into the future and show people where they'll be financially. If that's something that's of interest to you, come and see us. We'd be happy to build a model. Once again, we build it based on income that we know will exist, on assets with projected rates of growth over time, and with your lifestyle expenses. And we build that into the model, and then that gives us a window. Once you see your financial future, sometimes people like what they see, sometimes they don't. If they don't, it can mean, well, let's adjust something. Let's downsize the McMansion. Let's work a few more years, full-time or part-time. Let's create additional guaranteed income. Let's delay Social Security. We can show you the impact of all of those decisions on your financial future. The second major factor, this is not an optional. We all got to pay tax. The federal government loves collecting income tax, and state governments love collecting sales tax and property taxes. But within our practice, we show our clients different strategies for paying legally less tax. This is something that doesn't happen automatically. You have to plan for it. In the case of qualified funds like IRAs, 401ks, I mentioned one way to convert an IRA over to a Roth and generate tax-free income. But we have other strategies, such as doing gradual Roth conversions. And we show our clients how to do it tax efficiently so that in the future they pay less tax. Another factor that most of us will encounter in retirement is long-term care. This is where our practice started back in 2003. It's probably the greatest risk each of us faces. I mentioned earlier, we're living much longer. What's the downside to longevity? Well, our bodies wear out, or sometimes our brains wear out, get foggy, get dementia, get Alzheimer's. But we're still here. Paying for long-term care at home or in a facility can be frightfully expensive. So with all of our clients, we have the unpleasant discussion. If it happens, how are you going to pay for it? And we have some great strategies. One of them is tapping into Medicaid benefits for folks that end up in a skilled nursing home. We show our clients how to protect some or all of their savings, everything, and qualify for Medicaid benefits in a skilled nursing home. We also work with the VA on a program that's available for wartime veterans and their spouses. It pays a lifetime pension for wartime veterans and their spouses when they're needing, receiving, and paying for long-term care. So there are ways to get the government to ante up and help pay for long-term care. We can show you how to do that. There's also private insurance products that we can explain if they're of interest. The last one is protecting your wishes. All of us know what we have today and where we want our assets or savings to go in creating a legacy in the future. But to get those wishes sustained, you need to create the right legal documents to protect your wishes. And there's two classes of documents. Those that apply while you're alive, I call them living documents. Think of financial and medical powers of attorney. They appoint somebody to make decisions for us while we're alive. There's other living documents that apply while we're alive. And then there's the after death documents, wills, trusts, beneficiary designations, ways of passing assets after we die. It's important to have these documents in place so you can make your choices known while you're of sound mind. If you don't make your choices known, there are options, but they're not very pleasant. One of them is guardianship. That's where I'm alive, but I can't make decisions for myself, and I haven't appointed either a financial or a medical power of attorney. So guess what? A court appoints one for us. That's not good. Might be somebody you don't want to make decisions, but the court overrides your choices. We also are big fans of avoiding probate. What is probate? Probate's a legal process after we die of redeeding our assets, like a home, a vehicle, or financial accounts. But we work with our clients to put a beneficiary designation on all of their assets. If you do that, guess what? There's no probate. Still good to have a will stating what your wishes are, but if you have beneficiary designations on all of your assets, they pass directly to the people you've named, and they're not part of public record, which probate is a process. It's public, so someone can go to a probate court and see exactly how much and to whom you gave all of your stuff. So these are other areas where we work with clients. One last one, I didn't put it on this slide, but it's making important Medicare choices as we age into retirement. Most of us are covered under group health while we work, but guess what? We get into retirement and we rely on Medicare, and there's a lot of choices there. There's supplements, there's original Medicare, supplements, drug plans, advantage plans, and we help explain the pros and cons of each of these choices. When you pick Medicare choices, you're picking a long-term horse in the race, because years later, when your health has failed, you may decide you want to change, but you can't because you're locked into what you've selected. So choosing wisely up front, very important. We covered a lot today. 3 different ways to pay for retirement. If you have questions about, will your money last as long as you do? What sources will you tap? Will it be your home? Will it be retirement accounts? Will it be income sources that you have available? Each one of us has to build a plan that's tailored for your own specific situation. And we help our clients make smart choices. We talk about the tax, legal implications, credit lawsuit implications of each one of those choices. So if you have questions, please give us a call. Our consultations are always free. Our phone number is on the screen, 512-835-0963. Always happy to answer questions and give you the sense of peace of mind, because really what our focus is peace of mind. We want our clients to sleep well at night, knowing that their assets, savings are going to do exactly what they want them to do and support their lifestyle. Many of our clients want to leave a legacy. We show our clients how to tax efficiently do that. So if you have questions, you can call us. You can visit our website, srctexas.com, for more information, and to download a copy of our book if that's of interest. So I appreciate you joining us today. If you have questions, please give us a call. Have a great day and have a happy retirement.